So it needs to stabilize above it and then able to rise toward the top. If it fails, it takes more time, then it will delay the rebound somehow.
Hello, Bruno, and thank you for joining us again. It's been a very crazy couple of weeks, lots of turmoil in the markets. What is the key to watch, with that being said?
Well, hello, Jack. It's good to be back. Well, I think the main event is, besides the equity correcting, is really to look at what happened on the US 10-year yield. And here we have over 10, 15 years, the charts on a monthly basis. And we noticed that there has been a rise, right? A high, higher highs, a low and higher lows. And this is basically the definition of an uptrend. Yeah. Why is this important? Because before we had a downtrend, and we are coming right now close to this upper Bollinger Bands, but also the long-term resistance trend line. And most probably it will test this 3% that we had in 2014 when we had the tantrum, the Fed trying to announce that they may do something. We also noticed that this whole thing here for over 5 years is really a base, and it has the potential then to go much higher. But once in a while, first of all, what we should notice is that around 3% it could stabilize a little bit.
Mm-hmm. So what has this rise in yield, what are the implications been on the US sector?
Well, it has quite a few implications. First of all, the one sector which is the most benefiting of it is the financial sectors. As we see here, we have the same line of the rising yield here, and in the dashed orange line, we've got here the relative strength, which is also rising, so the correlation between both are strong. And of course, the small correction, if we want to call it that way, that we had last week, is still holding above the long-term rising uptrend. So it has been a correction, but the uptrend is still intact, and it should go on like that. Mm-hmm. However, of course, the sector which is influenced negatively, as we see it by the declining relative strength versus the S&P, is the utility sector. Mm-hmm. And there, we did not just broke the uptrend, but we went all the way back almost to the beginning of 2017. So here we have a very divergent sector.
Will the S&P 500 be able to rebound back to its previous highs?
Well, Jack, I think it is the right question to ask. That's now a little bit an open debate. If we look at the weekly charts, what we've got is the correction went to hit the moving average of 40 weeks, which is 200 days, and it rebounded. And it rebounds now. We have to see if it's able to continue. We look at the daily charts. On the daily charts here we see the nice rebound with a huge spike last week. And it's coming to the place where it had found some resistance already in the first week of correction. So now either it's able to extend toward 27.75, or it's just pull back, which would be more normal behavior and probably better for the longer terms before it resumes the uptrend.
Mm-hmm. So what will be the key factor, do you think, for this?
Well, we have seen the financial going up, utility going down, but really the FANG, which is a technology-related sector, has to continue to go up, and it has to be able to move above this dash trended line, which is the former support which has been broken. So it needs to stabilize above it and then able to rise toward the top. If it fails, it takes more time, then it will delay the rebound somehow.
Mm-hmm. Are we able to get any clues from Europe or Japan?
Well, not too much. Let's look at Europe versus the S&P. The dashed line here is going down. Relative strength is declining. That means it's underperforming the S&P. And we notice that here also, immediately on the chart, the rebound is relatively modest here. Of course, we are at oversold area, so that doesn't mean that it's not going to continue to hold above the key support of 3,300. But that's not going to give any lead. And Japan looks a little bit more bullish in the sense that the main trend line is still intact, but we see two things hindering it. Number one, the relative strength versus the Nikkei is moving down, and the yen, because the dollar is moving down, the yen is moving up. And that's hindering the rise of the Nikkei. Probably will remain in a range between 21,000 and 23,000 here.
Mm-hmm. Let's jump over to emerging markets then. Are they more bullish?
Well, emerging markets are still relatively bullish, even despite this correction. Looking at 10, 15 years charts, we see that after a test of 48.80, we made a new high recently in January and then pulled back and let a spike, but above the rising trend, it's rebounding. Key is this line, the black line here, which is the relative strength of the emerging market versus S&P 500. We noticed that emerging markets usually are more volatile because more risky, but here they're still outperforming the S&P 500, so that means that they are still in an uptrend. Mm-hmm. Also, if we look at India, here the bullish mode is even more pronounced because here we are at much higher level above the previous highs at around 25. So we have still a lot of rooms to pull back or do anything, and we see that here the relative strength is about flat. So here also, despite a momentum which was a bit toppy, the uptrend is intact.
Mm-hmm. Also, in terms of sort of this crazy turmoil, it's always good to have a little look at gold. Should we see what's going on over there?
Yes, people are speaking about inflation and comeback or rising yield and so on. In fact, what you should notice one thing here, the price of gold in euro is about flat in the last 4 or 5 weeks. But the price of gold in dollar is making a very nice base over 5 years. And if it breaks 1,390, then it opens up basically not only a 1,600 area, but a bit higher. So it is a relatively bullish pattern with momentum turning up. So probably it's not too bad to have part of gold in your global allocation.
Amazing. Bruno, as always, thank you for your expert analysis.
You are welcome.
And thank you for watching. And remember, me and Bruno will be back in 2 weeks' time. So see you then.